Welcome to Debt Matters. We're going to get straight into a story from UK consumer finance today. One that, well, it has the potential to really reshape how firms handle things like customer complaints, how they manage arrears, and even just their basic customer contact operations. We're focusing on the Financial Conduct Authority, the FCA, and its work on a redress scheme for motor finance customers.
That's a key point for you, the listener, because while this all starts with car finance, the impacts, they won't stop there. The kind of scrutiny and the sheer volume of customer contact this generates, well, that can land on any credit control or customer support team. If you're in collections, this will affect you. So what we want to do is look at what's happening, why the timeline is so tricky, and what you really need to be doing now to get ready.
Right, it's a conduct issue that just happens to be starting in one specific product area.
Hmm.
So let's start at the beginning. The FCA is looking at compensation. What was a specific practice that led to this potential problem for customers in the first place?
It all comes down to certain commission arrangements. Specifically, the incentives that were paid to brokers or car dealers for arranging the finance deal. In the past, some lenders basically allowed brokers to adjust the interest rates they offered to customers.
Okay, so they had discretion.
Exactly. And the higher the rate they set for the customer, the higher the commission they earned from the lender.
So just to be clear, if a customer could have qualified for, say, a 4% rate, but the dealer offered them 6%, the dealer got a direct benefit from that 2% difference, even though it cost the borrower more over the life of the loan.
That's the mechanism right there. That's the potential for loss. And the FCA's concern is, well, it's twofold. First, these arrangements weren't always properly disclosed. And second, it created a system where the broker had, a direct financial incentive to push up the cost of borrowing. So the FCA's goal is pretty straightforward. They want firms to compensate the customers who may have paid more than they should have because of these commission structures.
Okay, so compensation is the goal. But this is where it gets tactical for anyone in operations: the timeline. We're seeing reports that payouts expected in 2026 could face delays. What's driving that risk? Is it just about the total amount of money involved?
The scale is definitely a factor, but it's really the complexity and the legal side of it that's slowing everything down. The first hurdle is just the cost. Early estimates are proving to be not very reliable. Many analysts now think the total bill could be much, much higher than first thought.
And when the financial exposure goes up like that, I imagine the firms start scrutinizing every detail.
They do, and that's when the lawyers get involved.
Of course.
And that's the biggest risk to the timeline. Legal challenges. If firms don't agree with how the regulator wants to calculate customer loss, or if they feel the rules go beyond what the courts have supported before, then you can expect litigation.
Which is
very slow and expensive. That alone could push the whole thing way beyond 2026. And the actual modeling of the loss is, well, it's incredibly complex. You're trying to figure out what a customer would have paid in a completely different system.
That's a really difficult thing to prove, isn't it? But even if you take the legal challenges off the table for a moment, just the operational side must be a huge headache. We're talking about finding and checking data for millions of old agreements.
Oh, it's an immense operational job. Just think about the logistics. Lenders have to find agreements that might be 10 years old, maybe even older.
And the data quality back then.
It varies wildly. Between firms, between different systems, it's all over the place. Then you have to validate it all, calculate the refunds consistently, and you're often dealing with firms that have been through mergers or buyouts since then. And that's all before you even announce anything to the public and get that, that inevitable flood of inbound calls and claims hitting the contact centers.
So that operational burden itself is enough to create serious delays.
It absolutely is. It makes that 2026 date look very, very optimistic.
Okay, that brings us to the key dates. The things that collections and customer support teams really need to have marked on their calendars. If the actual payouts might be delayed, what are the concrete milestones we do know about that are going to trigger spikes in customer contact?
The FCA has given us two really critical signposts. The first is that we expect the final rules for the scheme in early 2026. That's the moment the industry gets clarity on the who, what, and how of the whole process.
And that clarity is going to be the first trigger for a wave of calls.
It will be, yes.
Yeah.
The second those rules are published, customers who've been waiting, or maybe people who weren't sure if they had a claim, they will be galvanized. You're going to see a huge wave of renewed complaints, queries, and claims activity hitting those frontline teams.
And the second date.
The second signpost comes later in 2026. That's when normal complaint handling procedures are set to resume. The SCA put a temporary pause on certain complaint timelines for this review. When that pause is lifted, well, you'll have a backlog of existing cases plus all the new ones.
So you get hit twice.
Exactly. Early 2026 and later in 2026. Those are the two guaranteed pressure points. Teams should be preparing for those volume spikes right now.
That's a crucial point because it lets us step back a bit. Let's say I'm running a collections team for credit cards or maybe mortgages or even utilities.
Yeah.
Why does a motor finance scheme matter to my day-to-day work? How far does this really reach?
Well, if we connect this to the bigger picture of regulation and just, general consumer behavior, there are four immediate knock-on effects for any collections operation. Doesn't matter what the product is.
Right.
First, you're going to see a rise in disputes during the collections process. Customers read the news. They hear lenders are paying compensation for unfair loans. They don't always differentiate between a car loan and a credit card.
So they'll start challenging their credit card balance because of something they read about car finance.
They will. They'll challenge balances, interest, fees, anything. They'll argue their agreement is under review or that they're owed money from someone else.
That's a huge complication for an agent trying to manage an arrears process.
It is. It's a kind of regulatory spillover, which leads to the second impact. More pressure around affordability and vulnerability. Think about a customer who is expecting a redress payment. They're banking on that money. If that payment gets delayed, pushed back to late 2026 or even 2027, their financial hardship doesn't just stop. It continues, or it gets worse.
So the delay itself becomes an operational risk for every other lender that customer has an account with.
That's it exactly. Their hardship is prolonged. And that means your organization needs really clear forbearance options and a robust process for identifying and supporting vulnerable customers.
And that links to documentation, I assume.
It does. That's the third effect. The need for critical documentation, for an audit trail. If an account ends up in late-stage collections or goes to litigation, every part of your conduct will be scrutinized. Not just the original motor finance agreement, but how your team behaved when the customer first raised a dispute with you. Call notes, letters, payment plans. That whole record of how you responded becomes a crucial audit trail.
You have to be able to prove you were fair and consistent.
At every single step. And that brings us to the fourth point, which is just elevated conduct and reputational risk across the board. How firms communicate with customers now is going to be judged later. This isn't about defending the past. It's about making sure your current communication is perfect. What we're seeing is that operational consistency, being clear, and being fair. Those are your best defenses. They reduce complaints and protect your reputation in the long run.
It really sounds like the whole lending industry is being pushed to a higher standard of transparency, whether they were involved in car loans or not. So let's make this really practical. What should collections, credit control, and customer support teams be doing right now to get ready for those 2026 spikes?
The preparation has to be about operational control and message discipline. I think there's a clear 5-point checklist of actions. First, update your agent scripts. Now, agents need to be trained to acknowledge the issue. They can say the FCA is reviewing commission structures, but they have to be explicitly told not to give legal advice or make any promises about redress.
Right, no speculation, clarity over commitment.
That's the rule. You have to manage customer expectations very carefully.
Okay, what about deciding when to pause collections activity? That's where it can get really messy.
And that's the second step, defining clear dispute triggers. Teams need to know with surgical precision when to pause escalation, what evidence to ask for, how to stop different departments sending mixed messages.
For
example, if a customer claims they're owed money on a car loan, your credit card collections team needs a clear policy on whether that pauses default action on the credit card. It stops confusion and future criticism.
Makes sense. What's third?
Third is strengthening your quality assurance. Your QA focus has to shift. It should be looking specifically at the tone of voice in calls, checking affordability assessments, and confirming compliance with treating customers fairly, or TCF principles.
TCF is obviously not new, but it sounds like it becomes the main shield here.
It does. It's your primary defense against claims of poor conduct during this whole period. And that QA work has to be continuous. You can't just spin it up when the rules land.
Okay, number 4.
Fourth is a classic, but it's often overlooked.
Yes, sir.
Resource planning. You have to prepare staffing and training plans specifically for those volume spikes in 2026. These won't be gradual increases. They will be sudden, massive influxes of stressed customers.
And you can't afford to be under-resourced when that happens.
You cannot. And finally, number 5, you have to tighten up your signposting. Make sure agents can easily and clearly direct customers to 2 places. the official lender complaint routes, and external free debt advice services.
That transparency builds trust.
It builds trust, and it protects the firm by showing you offered impartial help.
So this whole story is really an operational readiness challenge. It affects how customers talk about their arrears and how quickly disputes can escalate no matter the product. The conclusion seems to be that if you're in any customer-facing finance role, the time to get your processes ready is now, not in 2026 when you're in panic mode.
I agree 100%. And, here's a final thought to take away. If this motor finance scheme forces the entire lending industry to standardize clear communication and more transparent dispute systems now before they're forced to, how could that readiness fundamentally change customer trust and engagement in the future? That new, higher expectation of fairness and clarity from customers, that could redefine the entire relationship between creditors and customers going forward.